we make money by buying low and selling high. So if you take from April last year through the end of the year, the market rebounded 20, 25, 30%, depending on what sectors you were invested in. So what we do for our clients who are withdrawing 4% a year is we use a big upturn like that to trim some of their positions, 1, 2% of it, move it into things like short-term bonds that are yielding 4, 4.5, 5%, but don't have market risk and volatility. And we generally try to keep those clients 2 to 3 years ahead in their liquidity needs. So use an example. Let's say I have a client with $1 million portfolio, and let's say they're taking out $40,000 a year from that 4%. We'll try to keep them where we've got maybe $80,000 of the portfolio sitting in things. We'll strategically use those upticks in the market, sell a little bit high, put things in lower risk assets, and then have dividends pay in cash so that not if, when the next downturn happens, right? I've done this for 38 years. I've been through, I think the last time I counted, it was 21 different significant downturns that were related either to financial crises, geopolitical issues, or health pandemics, right? It's not just COVID. We've been through SARS and we've been through swine flu and we've been through these before. And you've got to have a strategy to get through those. So I had a client who, I'll share this story with you really briefly and then move on from there. But I had a client who in the United States, you have to take minimum distributions from your retirement accounts once you hit a certain age. And this client in 2022 was hitting that age where he had to take his first required minimum distribution. And he was supposed to come in and see me in November, and he was scheduled to come in and see me in November. He called me in October and he said, Jesse, you know, Russia invaded Ukraine, the Fed's raising interest rates, stocks are down, bonds are down, and I have to take this distribution. What do you think I should do? And I said, well, last December when the stock market was at all-time highs, we sold a little bit high. We put that money aside and we have enough money sitting in low risk assets to cover your required minimum distributions for 2022, 23 and 20 and with dividends 24. So we don't have to worry about what the headline in the news is today. So what I think you should do is probably turn off the TV and go play some golf or go hang out with your grandkids, right? And he was like, that sounds like a perfect idea, right? But you've got to have a strategy for managing that liquidity liquidity plays right into resilience, right? That's what helps people not panic and do the wrong thing at the wrong time.
Yeah, as a younger investor, we still have to learn that we should be patient and that knowing as well prices go down. Happened to me too often that I bought actually a stock too expensive
Yeah.
just for like knowing, yeah, it might go up still more, but I just want to be in there already.
Yeah.
And it doesn't make sense.
Well,
Just have
one
to
of the
wait.
best things I ever saw, and I'll keep this real brief, but back in 1987 when I was brand new to the business, I'm 22 years old, right? One of the best presentations I ever saw, and I still use it every once in a while with clients, is if you take a look at a long-term chart of the stock market, right? 50, 70, 80 years of performance. They said it's like watching somebody walking up a hill bouncing a yo-yo, right? It says like the yo-yo is the year-to-year volatility, but if you look at the long-term trend of the market, it's actually relatively stable. And they said, if you want to be a long-term successful investor, watch the hill, not the yo-yo, right? You just got to pay attention to what that long-term trend is. And then if you're going to watch the yo-yo at all, watch it so that when it's in a downturn, you can buy low,